Dan called me and said, Adam, I want to give a speech. I said, great. He said, don't you want to know what it's about? I said, sure. He said, it's going to be important. I said, okay. And here we are. There's an awful lot of meat there. There's an awful lot of statements that are provocative, but are not provocative to be provocating. They're provocative as a result of a lot of thought. Before I open up the discussion, I'd just like to pose two questions, if I could. First, you talked a lot about Basil, Basil III. You talked a bit about Congress, about the Fed's role. Where do you see the FSB in all this? What should the priorities be at that level of discussion? Or do they not have a role at the FSB?
No, I think actually, Adam, is this on?
Apparently not.
Probably bellow enough as it is, but
try that.
I think there's the green light. Okay, that should be better. No, I think, Adam, that the FSB actually has a very important role to play, and in many respects, even more important than it played with respect to the capital agreements. Because as all of you probably know, fundamentally the capital agreements, both Basel III and the SIFI surcharge for GSIBs, were worked out, concluded, agreed to in the Basel Committee, and then had hands laid on them by the governors and heads of supervision in Basel meetings.
Please continue.
Okay. The FSB played a kind of advisory role, and of course there's a considerable overlap between the institutions that are represented on the Basel Committee and the FSB, but it was not the center of activity on these things. With respect to shadow banking, short-term wholesale funding, I think the FSB is the place for international discussion. That's where, for the reasons I've just indicated, we're not talking solely about banks or any other particular kind of institution, but instead talking about the operation of funding markets, and thus bringing together regulators who are both securities regulators, banking regulators, in a single forum is, I think, probably the only way to make some progress here. And some of you may know that I've just inherited, been given, not quite sure what the right passive verb is, but the chairmanship of the Supervision and Regulation Committee of the FSB. This was the one that Adair Turner chaired over the last few years. And I would say the central focus for that committee going forward is very likely to be shadow banking, including consideration of this universal margining idea, which I mentioned a few moments ago. There are a few other issues there. There's right now, I know of great interest to some people at the head table. There's a consideration of systemically important insurance companies, and there'll always be some other things. But in keeping with my view that shadow banking, short-term wholesale funding are the areas that have been least addressed, I think what I'd like to see that committee and the whole Financial Stability Board do is to zero in on those using the benefit of a broader range of agencies and expertise.
That's really great. And following up on that, great as an answer. I'm not endorsing the position, but following up on that, as you started out, you were talking about you want to avoid a situation where the right regulations only apply to a subset, the prudentially regulated institutions, and you rattled off broker-dealers, real estate investment trusts, hedge funds. Can I ask you, why include hedge funds, since despite them being disliked, they don't have small depositors and they generally don't seem to have been as big a problem, or maybe we all missed it in the last crisis, and why not include, in a sense, money market funds, which are obviously not wholesale, but which remain a key part of this sort of getting around the prudential way?
Right, okay, so there are two things to distinguish here. One is regulation of institutions or a class of institutions, and the other is regulation of transactions. Now, I, as people probably know, have been an advocate of reforming the money market fund regulatory structure, and I think that should be done, and I think the SEC is going to do it. That needs to be done in any case. I'm not, I did not suggest here regulating hedge funds qua hedge funds. What I was suggesting was that if anybody is in the repo market, it shouldn't matter who they are or what kind of firm they are. If you believe there is a macroprudential risk associated with these markets, then the efficacious regulatory measure needs to affect every transaction.
Of that nature.
Of that nature, right. So now let me hasten to add, and this may have not been clear enough in the, reading the speech last night, and you always see things that could have been a little clearer. When I posed the issue kind of in the alternative, we could go with increasing capital and liquidity requirements for the regulated institutions, or we could go a universal margining route. And then with the addition of saying, regardless of which way we go, we need to do more with the very biggest guys. I should probably make clear, I have a clear conceptual preference for the universalism by transaction. The question, though, is going to be, can we achieve it? And the questions of can we achieve it will include, first, the conceptual questions that I tried to identify. Can you figure out a way to calibrate it differentially that seems to make sense across financing markets? Can you figure out ways that it's not eminently arbitrageable? Are you missing things? All those kinds of questions. But I think there will probably also be some question of who's got the authority to do it. We tend to have authority based upon prudential matters that's institution-based, whereas sort of market functioning matters, that's based on the markets among the market regulators. And so there'll be perhaps a legal question in some countries, certainly a political or policy question as to who would be enacting these kinds of generally applicable transaction requirements. Thus, we have to keep in mind the possibility that we may have to fall back on what is a conceptual second best, saying if we do cover all of those who are prudentially regulated with respect to their wholesale funding, their shadow banking type transactions, will we have covered enough of the market to make it worthwhile? And do we have at least some reason to believe that there won't be a very rapid arbitrage out of those markets? And if we can't answer both of those questions as yes, then it probably doesn't make much sense to go that route, and it really argues strongly for redoubling efforts to go the universal route.
Thank you. That's very clear. As usual, we're going to ask that the first 2 or 3 questions come from our guests outside the Institute. People in front, make yourself known. People to the back, please head to the microphone. If you want to give the microphone to this gentleman first, please. Please identify yourself when asking a question.
Thank you. Andres Portilla with the Institute of International Finance. Governor, thank you for your remarks. 2 quick questions. The first one, what is in your view the future of risk-based capital? I mean, you alluded to your preference for standardized risk-based capital, but increasingly there are calls by some fellow members of the Federal Reserve and some other policymakers about the need of non-risk-based measures, a high leverage ratio, basically under the assumption that risk-based doesn't work, it is too complex, can be gamed. So I would be interested in your views on that. And the second one, you didn't mention the recent proposals by the Fed on foreign banking organizations here in the US. And since that is out for consultation, I'm sure you have limitations on talking about it. But on the preamble, there seems to be a justification in terms of the potential lack of cooperation and coordination with foreign supervisors if it comes to a situation of crisis of one of those institutions. Are you able to elaborate more on those concerns that would justify those measures?
Okay. So first off, I should say you've just given me some news that members of the Federal Reserve have been out arguing for the leverage for a higher leverage ratio. So you should. I mean, I think there's been a lot of talk about a higher leverage ratio, and I want to put it in the context that I alluded to here, and try not to repeat a speech I gave maybe a year and a half ago.
You can summarize it, though.
I am going to do that. My view is that there is no single measure of capital which is adequate for a reasonably effective and efficient bank regulatory system. That So, what's the classic reason why we ended up with risk-based capital measures? It's because the use of a leverage ratio alone produced an awful lot of arbitrage, whereby there was an incentive for firms to go to the riskiest composition of assets, because it didn't matter whether they had a treasury or a loan to a new business in a garage somewhere with no collateral. It was thought it was risk weighted de facto the same. So that actually is what produced the sort of the move to risk-based capital. And if you look at the academic and policy writing in the early to mid-'80s, you will see that theme again and again and again. So we have risk-based capital, but risk-based capital has its own limitations, basically for variance on the same reason. And that reason is that once you start creating categories, there is opportunity for intentional or unintentional arbitrage within each of those categories. And particularly if you, the regulators, get something wrong, there's a hole in there, there's an opportunity for arbitrage, then the firms, again, have an incentive to load up on those kinds of assets which are de facto being underweighted. And so the leverage ratio kind of provides a check, or as I describe it, a complementary role in making sure that there's a limit to how much of that can be done within the confines of an existing risk-based system. So that's why I describe the two as having a traditional complementary relationship. Within the realm of risk weighting, you can either have a standardized set of risk weights, which conceptually you can understand as a bunch of leverage ratios put together. A leverage ratio for mortgage, a leverage ratio for corporate loans, a leverage ratio for sovereigns, put together, but obviously, by definition, somewhat more risk sensitive. Or you can do what the Basil II exercise was all about, which is trying to generate a system that produces on an ad hoc, risk by risk, credit by credit basis, a specific risk weight. I've obviously, in the book and elsewhere, evinced some skepticism about the ultimate utility of that latter approach, but it's in force in much of the world today. I guess I would say that my present view is that there are three, maybe 3.5, measures of capital which can exist in a complementary framework, each compensating for the shortcomings of the other, enough so that we contain the kinds of risks that we ought to be concerned about without requiring unnecessary levels of capital that could impede the extension of credit and thus stronger economic growth. The third that I would add, and I didn't say this in the book and wouldn't have said it 4 years ago, or 4.5 years ago, because it kind of didn't exist, is, from our point of view at least, our stress testing exercise. If I can put it in more conceptual terms, it would be risk-weighted, probably standardized, leverage ratio, plus something which gets substantially more granular, but is not the only thing you depend on. Now, I've become a big partisan of the stress testing approach just because of, well, I'm involved with it, maybe that's why you do. But I've seen how it evolves, and I've seen its potential since we did it first in the late winter and early spring of 2009. Its forward-looking, dynamic elements are really attractive. We create the adverse scenario, the severely adverse scenario, based upon what we see as tail risks every year. We are increasingly able to go into specific portfolios and make an assessment of those to minimize the amount of gaming that would exist in a standardized or models-driven environment. So I am partial to that as our third complementary measure. But you don't have to accept that. I think the key point is the measures need to work together and to reinforce one another. But again, I've never thought, and I continue to think, that no one of them is going to be adequate or central or the silver bullet. And that I did say in there. I just didn't have stress testing. Thank you, Adam. I didn't have stress. I just want to be clear, by the way, the Peterson Institute pays no royalties to its authors, so I get
make no profits, so you know. We publish you as a public service, which obviously paid off.
So that's what I think is key. Now, on the FBO,
you didn't know you were getting quite this much a treatise.
Yeah, that's right. On the FBO issue, I think you have to look at it in the broader context of what motivated us to do this. Well, of course, in the first instance, we were motivated by an instruction from Congress, which is, under Section 165, apply enhanced prudential standards to systemically important firms, which includes foreign banking organizations in the United States. And just to get a few facts out there, the share of the U.S. market that foreign banking organizations have occupied over the last several decades has been, in some respects, remarkably constant, fluctuating in the low 20s to about 25%. What has changed is the composition of the activities defined by that 20 to 25% of U.S. banking activities. In 1995, less than 15% of those FBO activities could have been fairly characterized as capital markets related. So the overwhelming majority was what we would think of as more conventional commercial lending, and to some degree deposit taking, but commercial lending activities. Today, half of FBO assets in the United States are capital market related. Half of the 10 largest broker-dealers in the United States are FBOs. 9 of the 20 largest banking organizations in the United States are FBOs. Not the world, just what's in the United States makes them 9 of the top 20. So this is a very different environment from the one that we faced even in the mid-90s. The results of that, I think we saw in 2008, when foreign banking organizations were a substantially disproportionate user of both the Fed discount window and all the liquidity facilities which the Fed created in order to try to keep the financial system afloat during that period. Firms, in some cases, had used their U.S. operations to raise dollars, which were then lent abroad, often for longer maturing assets. Dollars not being readily available during that period, there was the desperate need for liquidity, even among some firms that were receiving substantial support at home. Now, U.S. firms obviously found themselves in liquidity and capital squeezes during that same period, hence the motivation for so much of what we're doing. But I think when people say, gee, why are you changing things? In the very first instance, the answer is because so much has changed in the world. And because it is incumbent upon us, the Fed, as with the mandate for financial stability given us by the Dodd-Frank, us and other regulators by Dodd-Frank, which in turn, by the way, is kind of critical to global financial stability. We need to do something and change a circumstance in which a huge banking operation in the United States can have zero capital. It is just not a safe and sound situation to be in. Now, what's our attitude? So the question gets raised, well, does that mean you're no longer in favor of globalization of financial activity, or you don't trust your fellow regulators? No, it's I think, needing to be realistic about the world we inhabit. I mean, I sort of half stole, half adapted Mervyn King's catchphrase about the difference between local and global, that our big institutions live globally and die locally. Somebody is going to have to face up to the problems created when a very large broker-dealer comes under severe stress. And this is not a matter of mistrusting others. I don't think there was any mistrust during the crisis. What there was an enormous joint challenge, limited capacity of some firms and countries to respond. And thus, I think we, the Federal Reserve, and much of this was done before I got there, but some of it after I did, were necessarily in the position of trying to keep the United States financial system from imploding. And we just can't get around the fact that that included an awful lot of assistance to foreign banking organizations. Under these circumstances, I think it's only prudent to make sure that the largest ones have minimum capital and liquidity obligations here. Our friends, and I mean that, there's nothing sarcastic about it, I mean it as literally as it can be, our friends in the United Kingdom, in the FSA, and now the Bank of England, have required that firms, broker-dealers in London, not only be separate subsidiaries, but that they also have separate liquidity requirements and capital requirements, a development which, far from resisting, I think we applauded as an effort to come to grips with the differential situation in which London and New York, or the UK and the United States, occupy. We're the only two countries in the world which are hosts to these kind of huge foreign broker-dealer operations. Japan, Singapore, a few others are down a ways, and someday they may be bigger. But right now, we're the ones who are in that situation. So I think we have to do it. And then finally, because I'm almost re-giving the Yale speech, but that's okay. The final point I make is, well, does this mean you're against international globalization or international cooperation? No, of course not. But it's got to be, global financial activities, just like domestic financial activities, need to be conducted within a safe and sound framework. And here we are working as hard as we can to develop a promising, credible cross-border resolution process, just as we've worked together on increasing capital requirements, and I hope we're going to work together on shadow banking measures. But when you think about how such a process would operate, I can't imagine anyone believing that that process will operate without some sense of there being resources available in host countries that have very large operations, whether through capital requirements, through subsidiary-based bail-inable debt requirements, or through other measures. In a way, it is way more efficient to try to plan in advance for what may happen by having some of these requirements in place than to let happen what has transpired in the past, which is there are no such requirements, stress hits, every host country immediately begins dialing up on an ad hoc basis its ring-fencing activities just at the moment where the firm can least deal with it. So doing it in advance seems to me to have not a deleterious effect on a global resolution system, but actually a salutary one. So that, as you rightly said, I can't say where we're going to end up. I can explain, as I did, the motivation for this rulemaking. And believe me, we've got a lot of comments on this. We've got the poor folks who are now going to sit in their offices for the next several weeks or months going over these. And I'm sure, as always, we will make some adjustments. People will make good points. But that fundamental motivation is really quite critical. And I guess I would say I certainly myself do not expect to be convinced that somehow we were misguided in thinking in these terms. I just don't think that's the case.
Well, we're grateful to have gotten 2 speeches for the price of 1. And I do think we have time for a couple more questions. The two people at the back mic, and then Nicholas, and then the people at that table. So, please.
Hi, Dan. Nancy Jacqueline, Johns Hopkins SICE. Going back to the issue of the wholesale funding markets and the problem also of fire sales that typically come out of closeout of those kinds of contracts. One question is whether you can talk a little bit more about the role that counterparty exposure limits, if they are kind of creatively and rather more aggressively applied, might do a lot to deal with some of the problems you're trying to address through capital or margin requirements, and also whether that may help limit some of the contagion effects. Second,
One question will do. Thank you, Nancy.
And I'm going to be quicker on these.
Yes, please.
So on the counterparty credit limits, we've got a proposal out on those. I would say that's one of the proposals where we kind of think we need to rethink it some, and that's why we're doing a quantitative impact study. It is quite complicated when you get down into the weeds of what counts as counterparty exposure. I think the short answer to your question, Nancy, is they can be a piece of a complementary set of measures, but I don't think we can rely predominantly on counterparty credit exposure limits to deal with the short-term wholesale funding problem, because again, you could level that out some and still have a system that is very sensitive to getting pushed over the edge.
Great.
Clay Lowry from Rock Creek Global Advisors. Mr. Tarullo, I worry a little bit about your answer on the FBO at the end, where it sounded like almost nothing that anybody said was going to change your mind on how this went about. Maybe a detail here or there, because why I worry about that is not necessarily, there are obviously some financial institutions and so forth that are worried about that rule, but maybe moreover, I've noticed that Germany, the EU, the Swiss, the Japanese, and I'm sure there's a number of other countries that I'm not even aware of, who I would argue are also very in favor of resilience and worried about risks, have raised serious questions about the ruling that you've put out and saying that they are worried it's not being very well coordinated and it is fragmenting the global system. It sounds like you're, I mean, you didn't do this, but it sounds like you're being a little dismissive of their complaints.
Well, don't leave, because I got a couple of questions for you.
Well, no.
So if a broker-dealer from Japan or the United States takes up business in the European Union, what kind of capital requirements do they have to meet?
I'm not the expert you are, so.
Well, but you did ask a question about
Well,
this,
I
and you
asked the
seem to
question,
evince some
no,
concerns.
I asked the question about, it was an.
Okay, I'll give you
said
the
that-
answer.
you
Let me
said
give
that
you the
you're a
answer.
believer
I'll give you the
of
answer.
We got your question, Clay.
Okay. The answer is that they would have to meet Basel requirements, because under European Union law, the Capital Adequacy Directive applies to a broad set of financial organizations. In the United States, that's not the case. Unless you are part of a bank holding company, you don't have to meet those Basel requirements. And as I think I already noted, the UK has already put in place an even more stringent set, again, fine by us, but a more stringent set of requirements with a particular focus on liquidity. So I'm a bit bemused by complaints that somehow we are doing something that is a break with what's been done before. I think there is a break with the practice that has allowed a large banking organization with a big broker-dealer to have negative capital in the United States. But we are not breaking with really a fairly well-established practice in other parts of the world, which again I applaud, that do make sure that there are capital standards, strong prudential capital standards applied, as well as now liquidity standards. And with respect to what will change or what we don't change, I thought I was pretty clear, but maybe I need to restate it. That we're going to look at all the comments that come in. But what I was saying was the motivation for a change is based on a very powerful set of arguments and experience. And I don't think people can ignore that, as well, of course, the congressional mandate to take action here. It's not saying we won't change the proposed. That's the reason why you have proposed rules. I'm just saying that the notion, if people are expecting that their answer is going to be, gee, we were wrong, there's no problem. That's not, I just don't think that's certainly not the answer I think that we're going to come to, and actually I think it would be inconsistent with Dodd-Frank.
Okay, Nicholas?
Nicholas Veron here at the Peterson Institute and also at Bruegel in Brussels. Thanks, Governor, for what was a very, I think, insightful but also innovative speech, and not only because it introduced this new acronym SFT, which I guess is bad news for students for free Tibet, but is going to join the jungle of acronyms in this field. My question is about two things you didn't address, and I was interested you didn't. One is about Basel III adoption in the US. So now the European Union has found a compromise on its own capital requirements regulation, and it's probably not entirely compliant with Basel III, but it's there. So the US becomes the only very large jurisdiction that hasn't adopted Basel III. So this is in the hands of the federal agencies, including the Fed. Can you give us a sense of the timetable here? And the second question is about the Volcker Rule, which you didn't mention at all. So same question on this. Thank you.
Yeah, so probably slightly different answers. I mean, I think with respect to Basel III, it's moving along, and I guess the real news, if there is news, is it's moving along at a technical level, which is a way of saying I think most of the substantial issues that were raised in comments or the rest have been talked through interagency. I don't want to give people a false date as to when that may be done. I mean, my expectation is still within the course of the next couple of months. I just don't know exactly when, because as I say, one thing one does not want to do is issue it's one thing to issue a proposed reg that seems to have a technical glitch or inconsistency. It's decidedly suboptimal to issue a final reg, which seems to have an internal inconsistency. So, people at the Fed, the FDIC, and the OCC, particularly the lawyers, really want to do double and triple scrubs on it. But I think we're still in that general time frame that I alluded to during the last oversight hearing. On Volcker, I mean, Volcker sort of embodies the complexity of joint rulemaking, right? I've counted it up. There are 22 individuals who have a vote on Volcker, none of whom works for anybody else, right? They're all independent members sitting in 5 different regulatory agencies, the 3 banking agencies plus the SEC and the CFTC. And we've all got to kind of come to agreement, coming from somewhat different positions with a new sort of, it's not like doing capital rules where you've got a fair amount of experience doing it, so this was a new undertaking. Having said that, there's been a good bit of progress. It won't surprise you to know that the 3 banking agencies converged reasonably quickly because, again, I think we have sort of the same basic frame of reference. But my impression is reports are that things are moving along with the other agencies, and I know that Mary Jo White, the new chairman of the SEC, wants to work with us to get things through as quickly as possible. So again, I don't want to mislead people with a date, but I'm still of the view that we should be able to and we should get these 2 significant regulations out. And certainly, we're going to make sure they're out before the next time I come here, because otherwise Nick's going to ask the question again. I want to know.
Yeah, we'll make him do that. Gentleman right there.
Hi, Yalman Onaran with Bloomberg News. You talked about a higher leverage ratio for the biggest banks as one of the possibilities, and Basel III implementation is going through, and one of them is the Basel leverage ratio, which you also talked about. So should we expect that ratio to be, when the final rules come out, to be higher than the Basel III minimum, which is 3%, which you said is not high enough? And do you have a range of where it should be? Is it going to be double, triple? I mean, because the numbers, the details, matter.
You think I didn't put it in the speech because I was waiting for you to ask the question until I was going to...
Hope springs eternal for a reporter.
Now, so the real, I talked about it in the context of the largest institutions. And, in a way, I didn't say this before, but in a way, the leverage ratio with respect to the largest institutions, the short-term funding stuff, a lot of these things actually do overlap to some degree, because as I mentioned, the capital requirements for SFTs tend to be pretty low, precisely because if you look at them purely microprudentially, they're pretty low, whereas by definition they'd be weighted a little bit more in the leverage ratio. So no, I don't have a number for you, but that the idea is that given where we are, particularly with the largest institutions, a leverage ratio, for the reasons I explained in answer to the earlier question from a gentleman, is something that seems complementary and perhaps needing to be higher in order to serve that complementary purpose.
Very good. The gentleman there, then in front.
Arturo Porsekansky from American University. Some reflections on European banking experience of recent years. Clearly, your remark and the regulatory thrust is inspired by what happened in 07, 08 here. But starting in Iceland, ending in Cyprus, any reflections on what has happened there that might inspire regulatory growth here? Because it's not all about shadow banking, it's about traditional banking. It's not all about liability side risk, it's about also asset side risk and the interaction between the two. Any reflections on Europe?
Well, no, sure. I think it goes back. You have to have a strong base of what I would characterize as traditional capital measures on which one builds to take into account the particular vulnerabilities associated with shadow banking or short-term wholesale funding. And I would say probably each set of banking problems in each country have reinforced the need for higher capital levels and to make sure that the capital is real capital. And in many respects, those are the dual messages of Basel III. Your capital has to be higher, and we want it to be real common equity, which is actually higher. I would also say, though, I think that the experience since 2008 has reinforced concerns about short-term wholesale funding. Look, summer of 2011, where we had money market funds very quickly pulling out of some European institutions and then redeploying to others very quickly, once again reminded us that wholesale funding, short-term wholesale funding, can disappear as quickly as it appears, and I think sort of underscored the continuing vulnerability there.
Wow.
Thank you. Alberto Musalen from Tudor. If I heard the speech right, there was a reference to a regulatory tax on short-term funding operations to internalize systemic risk, and then separately, there was reference to a universal margining. Are those two different things that are being considered, or are those the same thing?
The transaction-specific?
Yes, exactly.
Yeah, that's a single thing. I think that the universal margining requirement is, I think,
is the regulatory tax that you mentioned.
Yeah, the regulatory charge, I think I characterized it as a charge, yeah. I was meaning to be a little bit more open-ended because it could be a margin. When I introduced it initially, sort of conceptually, could be a margin, could be a capital charge, I guess it could be a tax, although I didn't actually have that in mind, but something which applied to every transaction. Later, when I talked about the universal margining, that's sort of the specific manifestation, which is, I think, most being talked about now.
Thank you.
Sure.
No follow-up on that, Alberto? That all sounds good to you?
It's better than the opposite answer.
The follow-up was going to be, if it were going to be a tax, what was going to be done with the proceeds of that tax?
Oh, well, that we don't need to worry about.
No, that's what we don't have to.
They won't come to the Peterson Institute, so we don't care. Just joking. And Dan has given us incredibly substantive and comprehensive replies and been very forthright in his opinions. I had assumed we have time for one or two more, perhaps, questions. I had assumed he would have provoked further, but we seem to have a reticent audience. Oh, I see one at the back. Okay, Nancy, you can ask your second question now.
Interesting, they're worried I'm going to ask questions back.
Yeah.
No, I just wondered whether, you know, when you think about how we got in the position where we are today, which is how our credit system is really dominated by asset-linked finance, right? It's repos, it's the whole derivatives that are collateralized and sec lending. And where you have the risks created when you have closeout and netting and rapid fire sale of assets. A lot of this got created because we gave the exemption from the bankruptcy rules to closeouts in these contracts. And so essentially the credit system has moved away from anybody really doing credit analysis on counterparties. They're just, in a sense, trading assets and betting on the value of the collateral in the contracts. Have you all thought about that structure of our credit markets and whether there is anything...
You mean the bankruptcy exemption in particular, Nancy?
Well, no, but I mean that kind of led to this. But we have a very different credit market than we used to have, and people don't look at, they don't analyze their counterparties for credit risk in the same way. They're really just looking at values of the assets and the collateral on their balance sheets and how they're moving in the market, right?
Right.
Have you all thought about that risk parameter of our markets and whether you want, in looking at what you're doing with repo and some of these other funding issues, how you want to try to make the credit marketplace safer in a broader way? And that's, you know, that's kind of a 30,000-foot question, but it really is at the heart of what you're trying to get at after the fact. We've created this thing, and now our capital rules the way to try to deal with the fundamentally more risky credit markets that are pro-cyclical because they are so linked to asset values.
So I guess the answer is probably yes and no at the same time. Yes, in the analytics sense. I mean, we've done. There's been quite a bit of academic and sort of policy-oriented, you know, Peterson Institute, Brookings type work on these kinds of questions from which to draw. And indeed, there's one strain of thinking which is that the bankruptcy exemption is kind of critical to this, and if you could dial that up or down as needed, that might have a big positive effect. But I guess having said that, I think what we've tried to do is start moving towards what seem to us to be sensible and effective ways to try to regulate the short-term wholesale funding markets that I would say, I believe, not only do exist, but are likely to exist. I don't think, I used the phrase in the first speech here at the Peterson Institute after I came onto the board. I warned against, reform by, what I call reform by nostalgia. By thinking we could go back 30 or 40 years to some situation in the, status quo ante. And not only is that not going to happen, but there are reasons most of the time why good situations that existed before are no longer possible to achieve in some instances. There's a demand in the world today from a lot of different sources for short-term, safe, cash equivalent type assets. Emerging market central banks around the world in the wake of the Asia financial crisis thought there was a need for more self-insurance. Now that non-financial companies are rated to some degree by their liquidity positions, they have a desire to hold these things. We have institutional investors, pension funds, asset managers, mutual funds, others, who need to have readily liquid funds to buffer the various things that they run. These sorts of demands are not going to go in reverse. So I think we have to accept the proposition that there are going to be these demands. What we should be trying to do is making sure that there are not the explicit or implicit unpriced guarantees that lead to the use of these mechanisms and these funding channels in a way that creates more systemic risk rather than to contain it. And that's that's what makes the debate difficult, I think. And you know, people so Gary Gorton and Andrew Metrick and Andre Schleifer and Andrew Lowe, I mean, a lot of these people have written very incisive assessments and in some cases recommendations for what to do. I think all of them would say that it's not easy and there's not a single thing to be done. I think most of us have come to the view that we need to put a regulatory structure on top of what's happening to discourage some sort of things and to certainly allow others, because these things are so critical now, but to make sure, again, that we're not just allowing the buildup of systemic risk in a way that happened the 8 or so years before the crisis.
Anna, did you want?
If you have time.
Yeah.
Okay. So Anna Gelper, American University and Peterson Institute here. Thank you very much for your remarks, Governor. Taking your framing of capital adequacy regulation, it seems to me part of what you're saying is, look, whenever you have rules, you're going to have arbitrage, and therefore you need to amp up the discretion piece. And you could do it the way you described it, which is you have the risk-weighted module, you have the leverage ratio, and then you have the stress tests. But then the way we're going to mix them up is largely discretionary. And then if that doesn't work, then we might do more discretion. And I guess one is this broadly correct? And second, if it is at all correct, shouldn't we just focus on the stress test piece and elaborate that rather than kind of have these rules that may or may not be important?
No, so I didn't. If I did, I'm sorry for having suggested an excessive or a substantial amount of discretion. What I actually meant to be suggesting is that the leverage ratio requirement, risk-based requirement ought to be rules. They ought to be rules. There's always discretion in the administration of rules, in creating them and interpreting them and indeed enforcing them. And of course, the monitoring of the enforcement of rules is an important part of rulemaking. But I don't think there should be the sense of supervisory discretion to say, well, no, you don't really have to have this high a risk-based ratio, or you guys need to be a little bit higher here. I do think those should be set by rules. Even the stress testing is discretionary in the sense that we, the Fed, create the adverse and severely adverse scenarios each year. And it's discretionary in the sense that our people who do the modeling have to come up with a loss parameter for a particular portfolio. So there's discretion in that sense, absolutely, and I think that's the way you get some flexibility that complements the relative stiffness of the other two kinds of regs. But even so, it's applied across now all 18 and soon to be, I think, 29 or 30 institutions, in the sense that once we come up with that, we're driving everybody through it. We're making sure that they come above the post-stress minimum levels that we require. So I think you do need a mix of, as I've characterized them, not in a deprecatory way, somewhat stiff regulations and a more adaptable, supple complement to those, which I find myself favoring stress tests for that role rather than the internal risk-based modeling approach of Basel II.
Terrific. Dan, thank you so much. As I said, 2 speeches for the price of 1, but also an enormous amount of frank, clear thinking. Again, there's a lot of room for debate. I'm always sympathetic to policymakers saying, yeah, we'll listen, but we do have strong biases, and at some point, you're allowed to go with those, as long as, if it turns out to be mistaken, you turn it around. And I know that you and your colleagues at the Fed are fully willing to do that. But more importantly, you're trying to learn and help all of us learn. So thank you all very much. Let's give big thanks to Dan.